My talk today is on 16 years in the industry, and we've heard a couple of people talk about some of the companies that I've acted for, including the first one, which sold for about $470 million. And this is around the time, around 1999, when even the word startup didn't exist, or certainly not in the context. And the second one went on to another group out of a university, accelerator, just a bunch of professors, went on and sold their business for $35 million. So it's a lot more exciting than accounting, so I hope you're not going to get accounting information today, and certainly you're not going to get a lot of tax solutions, but I just want to talk to you a little bit about the types of things that are going to come up in the journey and looking after some very high-profile companies. So these are some of the companies I've advised. I'm mentoring, involved with investing in as well, and helping companies IPO like Bailador, Freelancer, etc. I've only got 10 minutes, and so I'm going to be whizzing through. One of the first guys that I was working with, started about 5 years ago, came in and saw another firm and said, look, I want to compare what you're talking about as well. And he said, look, what I want to do is I want to build a global marketplace. So at that point, I sort of said, okay, it's all very well to sell globally, but you're going to need to have an understanding of what sort of structures you're going to need globally, and where you're going to employ people, and what sort of transfer pricing information is important. So you need to make sure whilst you enjoy this great success, you're not leaving too much tax on the table in different countries or employing people. And when you start selling into countries that think, hey, what you're buying is actually a royalty and they want to take 30%, you might need to set up another company in that jurisdiction to make sure that you have a real very, very close knit structure around making sure that you're going to be ready for an IPO. And that's what we did only a few years after that, with helping with Matt on his very successful IPO. Oh, okay, it's nice down here. So one of the frustrations, and everybody gets really excited by startups and they're going to go and make $1 billion. But to be honest, the way I see startups is that they are really soldiers of fortune. They go to the US, they come back, they go to Singapore, they go wherever the talent and the money is. Now, the problem is you've got different jurisdictions that you're going into and out of. So when you leave the country, you start getting into some more complex tax rules around when you leave, you're deemed to have sold your assets at their then market value. That includes Australian companies that you've founded here. Or alternatively, you decide, well, what I'll do is I won't go through that path, and what I'll do is I'll set something straight up in the US. But again, at what point is the right time to pull the trigger and do that flip up or roll your IP into that US company? A couple of years ago, sort of 2012, one of the pieces of legislation that got snuck through was if you're an Australian individual, you go overseas, and then you're overseas for a few years, and then you come back. For the period of time that you're overseas, you're not deemed to be a resident. So any gain in your company's value is not taxed at the discount capital gain. Now, this is not rocket science, but it's certainly quite tragic to be losing or paying 49 cents in the dollar on a capital gain. So something to be very aware of. So, and you've got to really be able to think 5 steps ahead. You've got to be able to integrate with what's happening in the US, if that's where you're going, and knowing a bit about US law, a bit of Australian law, and making sure that instead of being taxed on everything and having all these tax leakages or getting arrested at LAX for not filing the right forms, and there's lots of forms overseas as well as in Australia. So very important to get that right. Well, another really tragic scenario, one of my clients that has raised money successfully, about $5 million from Telstra. So everyone starts with a great idea, and they might start with a couple of people, and they say, okay, next moves is let's incorporate a company, if they're, doing what most people do. But, there's two of you, so 50-50, is that fair? Well, the big question with a startup is how long is it going to take to get the job done? And in terms of how long it takes, how long will the founders hang around? So if you don't have a founder agreement which says if you don't hang around, you lose your shares, then you're in real trouble, because a lot of people can go in and have some shares without a shareholders agreement and founder agreement, etc. And what happens is you end up with, let's say you are successful, you raise money, and you say, look, I want to buy the other founder out because they want to go surfing, for example. and the other founder says, yeah, I'm happy to sell you my shares, but they're now worth $10 million. And of course, the remaining founder doesn't have $10 million or $5 million to come up with a payment. So you can see the dilemma there. So you've really got to make sure that you start to think 5 steps ahead. And not fair is a really misconstrued word, because fair is what you want to. Don't worry about fair. Make sure you protect yourself. I thought I'd quote myself. It's an incredibly tricky exercise in getting, from your IP into the, for example, Australian company, or do you go directly into the US company? And if you do go directly to the US company, is that US company regarded as an Australian tax resident? Well, if you're not there running it, quite probably it is, because you've got central control and management issues in having a company that's based overseas and you're still in Australia. So then if you go overseas, then again, as I said, you've got this exit issue. And then if you've got IP in Australia, next problem is, well, how are you charging for that IP? Are you selling it directly to companies globally? Are you letting the US companies sell it, or are you setting up a subsidiary? All of those questions are probably maybe right or wrong, or the answers are right or wrong for the time being, but then you're going to go through the process of raising more money, opening up in other countries, and hiring people overseas as well. And then down the track, you've also got to think about the exit. And so if someone's buying a company that's got this IP in Australia, and you've done a flip up to the USA, and so you've got a US company that owns the Australian company, how does the next buyer feel about having IP in Australia? Lots of questions to ponder. Another client of mine is Bailador. And I think when David Kirk made that quote, he was probably talking about Paul Wilson, but I'm going to claim a tiny bit of credit as well. He's co-founder. So in terms of getting the structure right and then going out and raising more money and having your governance right, it's incredibly important to have a little bit of understanding of you're going to be looked at. So this is not just looking at and the great stories we're hearing about 10 million customers and all that sort of thing. So there's two, I'm putting my sunglasses on for a reason. There's 2 images that you want to convey. One is to the public about how well you're going and your growth and your traction and all that sort of thing. But the other thing too is the ATO reads these great stories about yourselves that are, you've got this many customers, you're making this much money. So you want to have maybe a lower profile from the tax point of view. Now you can't, because obviously anything you're putting out there in the public environment, that's available to the ATO. There's forums that the ATO have, or groups that the ATO have, that look at high net worth individuals and look at all sorts of things that happen in terms of restructuring your capital table, or issuing bonus shares, or issuing new shares. It's very complicated. It might not be rocket science, but I tell you what, it can blow up, and there's been lots of examples of very successful entrepreneurs that have had lots of bad experiences with getting poor advice from the start. So share plans that finally make sense, that's another one of my quotes. Obviously, we've gone through 3 iterations of share plans in the last probably 4 years. Finally, something which I think makes a lot more sense, which is to have the ability, instead of having to pay thousands and tens of thousands of dollars sometimes and getting valuations for every time you want to bring a new person in, or you've got to pay thousands of dollars of tax advice. And even then, it's impossible. So from 1 July last year, we've got this great new regulations where, firstly, if you issue options at the market value of today's share, not using the typical valuations that take into, or the real world valuations that take into account IP, so the legislation now says if you can issue a share for the net tangible asset value of a company. So if you've, and really what the net tangible assets of a company are typically are going to be the computers, the cash in the bank, and bits and pieces like that. So that if you've got 10,000 shares on issue, and you've only got $10,000 worth of computers, you can issue options for $1 each, and then that's notwithstanding the fact that you might be raising money at $10 million, and you can be issuing these options to staff, or even to advisors, etc., and that then forms the basis of a much smarter decision, or a more compelling way of getting somebody in, attracting staff, getting people in, and also being able to continuously incentivise people along the journey rather than just at the start, which is some of the other legislation which was typically involve using share plans with loan plans, etc. So this is a lot more palatable for people. Another client, Kevin, talks about mentors. Obviously today's all about meeting people and hearing great stories. But again, in getting ready for an IPO, you've really got to think about some of the things that you do now to get your corporate governance right. Now, I don't want to talk too much about accounting, but because the only time I ever say I'm an accountant is when I'm going through customs, because an accountant would be too boring to do anything too dodgy. But it's very important to get your structure right. It's very important to get your, which includes your capital table and some of the other things that my speakers behind me will speak about as well. So incredibly important to get the right team around you, and that includes advisors. And finally, tax incentives for investors at last. Again, a David Kenney quote. Not that riveting, I'm not a poet, but one of the things I really like about the legislation now is it's law now, 1 July, that investors can invest in companies that are eligible under various rules, where they can get up to a 20% non-refundable offset against their income tax liability. So if you're a sophisticated investor, you can invest up to $1 million into a startup and get $20,000 back. And better still, the gain that you eventually hopefully make on that investment is tax-free. So there's a lot of, as usual, devil in the detail, but a couple of really important pieces of legislation have changed in the last 2 years. And as I said, 10 minutes, quick highlights. Hopefully you enjoy the rest of the conference. Thank you.
Thank you, David.